Hey guys, it is May from Markets with May, and I'm going to do one more quick earnings recap of BlackRock tonight because BlackRock is the first asset manager to report. It reported on Friday. It was a pretty incredible earnings report, but it also provides so much detail on what's going on in asset management, and as a result, so much about what's going on in the marketplace in which you'd expect to see in fund flows. Plus, they have this acquisition that Larry Fink has been with Baya Oboletsky. I'm not sure that I'm going to pronounce his name right, the CEO and chairman of GIP. But they have been going around marketing the deal. And I got to admit, it's a great deal. I'm going to actually talk through some of the things that Larry would never be able to say, Mr. Fink would never be able to say in a press thing, but it's just the truth, quite frankly. There's really not another way to say it. And then we're going to also go through the numbers as well as to what I'm looking at in BlackRock and why I'm saying it's an outstanding quarter. I do not have a position in BlackRock, I think. Okay, I'm just going to say this. I might have an options position that's just residual and hanging, and it would be long in BlackRock. But I think in general, I did not get those call spreads off. But if I was to pick a direction right now, it'd be long. The reason that I wouldn't be long in any kind of big way is because this market in general makes me a little bit nervous for financials, but this is a really good quarter. Let's go into it. You should just do you. The stock is this crazy $800 price, so it's not reasonable for everybody. Some people buy it on fractional shares, but hey, this market is so skittish. You do you. That's where I'm at. All right, first, let's just go through the numbers really quickly. First of all, this is the second time they've hit $10 trillion in assets under management. And if you're like, is that a big number? You're trying to figure it out. The answer is yeah, that is a ginormous number. It is up 16% year over year. Okay. That is unambiguously big. And AUM matters because this is a fee-based business. They get paid on AUM. I'm going to show you precisely how some of that was raising assets, and a huge part of it was just the markets doing well. So I want you to understand that part of the reason why I might be hesitant to take a bigger position in BlackRock right now is because a position in BlackRock is a market call. It is a very specific type of market call. It is both a fixed income and equities market call, but we'll go through that to make it super clear. Also, revenue up 7%, very strong. Most of this is fee-based revenue, but I'm going to show you something that's a little funky in here. I know my AMC people that watch this are going to be so irritated, but there's not much that you can do about it other than just realize this is a thing and see and understand how it flows through everything and why maybe my stuff is a little different from how other people think about things. Revenue up 7%. Operating margins are actually improved year over year. There's kind of this mixed discussion about the operating margins, but I'm going to talk through it a bit because, quite frankly, operating margins are going to vary depending on what people are investing in. Because it just turns out to be the case that although in general you can improve operating margins for a firm, the biggest thing that will improve operating margins is just by having people invest in a particular way. Strangely enough, ETF business, very low margin. Net income up 9%, great. EPS up 10% is because of stock buybacks they were doing. A lot of people are giving a shout out to the fact that PNC sold some part of their position of BlackRock, allowing them to take a slug down without huge market impact. Do I think that's a big deal? No. To be fair, it's about 1% of the total stock. But do I think that the buybacks continue and are a great thing? 100%. So yeah, Dylan, just let me give you a shout out. You are right. It was a crazy big quarter. Totally acknowledged. Now, there's a couple things I kind of want to mention here as well. Even on the adjusted numbers, that's fine. 150 million in shares outstanding means that you are paying nothing close to the fact that this has 10 trillion in assets. So it does come down from a valuation perspective, which I'll talk about later, to how you want to think about valuing an asset manager, which is anyone's guess. If you're like a multi-year buy and hold person, and you own the shares right now and you're asking me, was this a good quarter? The answer is yes. But I make no statements as far as anything else on that front. Okay, let's look at the net flows because this is where it starts to tell you what's going on in the markets. This is why I listen to BlackRock every single quarter. And if you look at the net flows, you have less money flowing in the fourth quarter into retail. So number one, you have long-term net inflows of 63 billion. That's a big number. Okay. 60, but 63 billion, by the way, is not a number that gets you to 10 trillion from the previous quarter. So we will see exactly where the money came from and what happened. And I'm just going to make, we don't have to really think too hard. It's really the performance that we had in the last quarter across all markets. By region, the money flowed in from the Americas, meaning the money flowed into investment in North and South America. Okay. You got a little bit of investment in Europe, Middle East, and baby tiny sliver into APAC. This represents an allocation between these three that is significantly higher Americas and significantly lower APAC EMEA, even though these are positive flows. So just realize that you can kind of see how the flow of investment has been going. Why is that important? That's important because if you look at this, a lot of this flow is, first of all, passive, meaning it's coming from these ETFs. These are not people that are taking anything other than what's called beta bets. They're not thinking, oh, someone has some really thoughtful way of looking at this. Okay. It's more like, you know what? I just want exposure to that. I'm not going to think too hard. I'm not going to try to find who's the smartest. I just want generalized exposure. Okay, you had net outflows from retail investors. Why do we not care so much about this and the institutional? The institutional is a little bit different how you interpret it, but the retail probably is because whatever they lost in people directly investing in BlackRock, mutual funds, closed end, that sort of thing, just went into the ETFs business anyways. So, the ETFs business for BlackRock was an innovation that they took to the next level. Okay. Barclays also has this business. A couple other people had this business early. Okay. Then some people came in after. That's the history of this business. But the whole concern at all points, and part of the reason why BlackRock went here, was they felt that the ETF business, especially the passive ETF business, was going to cannibalize the regular retail business anyway. So they're like, well, if we're going to cannibalize it, we might as well be the winner of that. And they are right now, obviously, the winner of that. The institutional business is a different animal, okay? The institutional business is going to be all about, the institutional business is going to be all about big asset managers. And I do have a video that I would absolutely recommend because everybody thinks the hedge funds are the big behemoths. No, the big behemoths that actually have a lot of money is the sovereign wealth funds and the pension funds, the big global pension funds. In the US, because of the nature of how we're structured, we break up our pension funds, and also the Fed and the Treasury create a different sort of animal. So that's just totally not the same. But every other country, it's either sovereign wealth or the big pension funds that amass all the people's money. And so the institutional business and the growth of the institutional business, when it does this is really kind of not necessarily good, so to speak. Okay. And so that money probably went into a combination of ETFs. So it could absolutely have just gone here. So they're not going to give the mandate to anything. They're just going to actively manage it in-house, actively asset allocate it in-house and not give the higher fee mandate to any company like BlackRock or whoever else might come in and try to ask for the mandate. Also, the other place that this money went is in cash management net flows. That's where the money went. So why is this important? Why do we care? This means that for those that were trying to find evidence of money on the sidelines, that's what this is evidence of, is money on the sidelines, okay? There's still money that has not been put to work. People have talked about it, but this is where you look for it. Sorry. Let me see. I just saw some of the comments because I was going through it. Okay, Super Steven, I will 100% come back to you on that because that's a really good question and it actually leads to the ETF business. Currently, all this, so this was a really quick question. This is the new Bitcoin ETF that's a spot ETF. And yeah, there is going to be some purchases. That's absolutely going to help. They have been, from what I understand, purchasing it all along the way. What you kind of want to know as relates to that particular thing is that it actually sits here in this business, in the ETF business. And I'm going to show you in a little bit why you may have mixed feelings about that. For the record, I have neither been a fan nor not a fan of the Bitcoin ETF, but I have been fully aware of both the pluses and minuses, which is why I prefer owning ETFs that are based on futures rather than ETFs based on underlying. So I will absolutely come back to those questions. I'm glad I took a peeky sneak on what you guys were saying in the comments. Please do. I will always make sure to come back to the comments if you have questions. Here, I only have a couple of slides. I'm going to go through GIP and then we can take questions. I know a lot of you guys will have the questions on the Bitcoin ETF. So here's the total institutional. They had net outflows, but AUM increased because of basically the markets doing well. Okay. On the act, that means that institutions did not put money to work. Instead, they just let the assets increase in price. By investment style, active management, money came out of that, and then you had the markets just do better. Then index and ETF, you had an opposite dynamic. That means that these managers just wanted exposure to beta. They weren't thinking too hard. They weren't necessarily allocating to one manager over the other. And then what I wanted to bring notice to here is that illiquid alternatives was the only part of alternatives that did well. So 3.2 billion outflows. This means the hedge funds had to make it off of their performance, and they did because last year was decent earnings performance, or excuse me, market performance. Currency and commodities, money came out, but you still had performance in the portfolios to improve the AUM. Yeah, not very much. I mean, it's a very small increase in AUM, but you can kind of see how things did. So this overall, very cool, very good. But like I said, it is very leveraged towards markets doing well. Cash management, by the way, that it continues to do well despite the fact that the market's doing well is a testament to the fact that rates are higher everywhere on this earth. Now, very briefly over this, and for those of you, I know you're really excited to try to move on to the next topic, but it is kind of relevant and important, this acquisition. I want to explain to you what's being said very briefly and what's actually in my head on this, which is not the same at all. BlackRock is buying Global Infrastructure Partners. That sits here. Okay, that deal does not in illiquid alternatives, which has 136 billion from the marking at this end of year. Now, this thing does not close, knock on wood, for BlackRock until the third quarter of 2024. So it does not include, this number does not include the additional infrastructure money. This slide right here demonstrates that on the combo, they will be the second largest private manager of private market infrastructure. Okay, what does that mean? Okay, number one, this is what they're investing in. Ooh, sorry. Is this the right one? No, this is something else I just wanted to show later. Let's see. This is what private infrastructure is. It's energy infrastructure, transport, digital, which is basically 5G related stuff throughout the nation, and then water and waste. A lot of this is actually just privatizing, okay? Then it's also airports and all this other stuff. That's what infrastructure is, and this is private money. And it's kind of important to understand how big this market is, okay? This market was not big in 2017, and it got very big during COVID, and it's going to continue to need global infrastructure funding. Now, what folks are marketing this as, there's a couple things they're marketing as, or talking about it as. Number one, they're talking about it as, oh, this is great for AUM growth. Let's talk about that really quick. I told you that BlackRock makes money off of the assets under management. They just take a straight fee for that. Well, the number that they currently have in assets under management is $10 trillion. You have, the one thing you want to think about is to make a 1% change in that, they have to raise $100 billion. That is a lot. If you look at the size of even the hedge funds that everybody is all over, if you look at the size of Citadel, you're just barely over $100 billion. To get 1% growth in AUM, they've got to bring in $100 billion. And so this actually represents a huge chunk of what it would take for them to just grow AUM 1%. But wait, the more important thing is yes. Okay, and the second thing, is yes, it is the case that these assets do really well. Okay, they do really well because they are things that necessarily offer a very boring but very consistent stream of revenue. They are toll bridges. They are things like, charging stations for Tesla. It's boring stuff like that just makes money, and that's what it is, okay? But the thing that you really have to understand about why I am stoked for BlackRock on this and yet slightly concerned at the same time is that infrastructure is the one thing that their clients that can actually give them numbers that would ever get them to another 16% of growth. So the big money that comes from sovereign wealth as pensions, the thing that they want to invest in is infrastructure. Now, let's talk about two ways of thinking about that. The first thing is that illiquid alternatives is what infrastructure is, meaning it is not fluctuating up and down with the markets at all. So they do not have to market to market, which was a big problem in 2008. They do not have to do anything but let it grow and build. The second thing, which is why sovereign wealth companies and these types of big pension funds, is because these types of companies, like the government of Singapore, Abu Dhabi, the nation of, the sovereign wealth of Abu Dhabi, that sort of thing, the way that they're thinking about it is that they can reinvest in their own country or in the infrastructure of another country. So a lot of times, maybe during the crisis that you saw last year with the banks, you saw like the Saudi Arabian princes coming in and trying to like bail out, Credit Suisse. That's a real thing. The other thing that they do is this type of thing. So realize that that's what is a part of this infrastructure business. It solidifies BlackRock's positioning in asset management from the biggest of the asset managers. And that's really fantastic for BlackRock, but it is a real thing that you just kind of want to be aware of as, person who's trying to understand macroeconomics and how it works. Okay. Last little piece of this guy, I'm really stoked because you need more diversity within financial services, period. And so, he was on the board of Goldman. So now he's resigned from that and he's going to be a part of BlackRock, which is good for him. It's clear that everybody is fighting for talented people of color. And so I'm thrilled to see that. Okay. This last thing I just wanted to show you folks, first of all, because all my AMC folks care about it, but also everyone that's so excited about the Bitcoin ETF and spot ETF. This is the number one reason why I wasn't a huge fan. Okay. And I don't know another way to demonstrate it except for showing you their slides so you can see it. This is how BlackRock makes its revenue. I've talked about the fact of base fees. This is fee-based revenue for the raising of assets, okay? Then there's performance fees. If you have a great market, you make performance fees. They sell this product called Aladdin. That's the tech services business. The distribution fees is the redistribution of mutual funds because we know what happened with respect to ETFs versus mutual funds. You're not going to get as big a number there. And then you've got advisory and other revenue, which is it's kind of something that you give to the institutional investors. It's very specific. We won't go through detail. But the thing that, let's just look at what number it was that actually helped them on full year revenue. It's the securities lending revenue, okay? That is the number one big grower from last year. And I've talked about this on the AMC videos that companies that are passive investors like BlackRock, like Vanguard, they do not hypothecate their stuff. It is a real they do not remove their stuff from hypothecation. Sorry, I said that exactly backwards. They all sign the rehypothecation agreement and allow stock lending, and they take the borrow rate off that lending. And they made quite a lot of money off the revenue last year off of lending out stock. So this is part of the reason why I have not been all excited about a Bitcoin ETF at the spot, because absolutely the stock associated with it, not the Bitcoin, because you can't, like, Bitcoin is it's not traded this way. So Bitcoin underlying is not traded but the ETF can be lent, and the lending of the ETF actually, and also the exchange traded note for that matter, has a dynamic that absolutely changes the price of the Bitcoin underlying. Okay. Now the only difference is that with BlackRock spot ETF versus the futures market, the way that you hedge that has a lot more impact on exactly how much you buy and sell of Bitcoin. Now, people have asked me this question, and I think you won't know until you know. The question that they've asked me is, what is the impact to the underlying Bitcoin on this? And the thing that makes it a little funky is that it kind of depends on how BlackRock manages or decides to manage the inflows and outflows associated with this ETF, because the ETF itself can trade at a premium or a discount. So technically they can let the price of the ETF trade at a huge premium to if you were to just calculate what is the Bitcoin worth divided by the number of outstanding units in the ETF, they could let it trade at a huge premium. And then if suddenly everybody wants to sell Bitcoin at the same time, they could just do nothing with what they owned in Bitcoin and allow the thing to trade at a big discount and do no changes whatsoever. However, there's a couple of things. Number one, you can't let NAV get crazy out of whack because then you really open yourself up to some very specific types of index arbitrage. Similarly, if you do the opposite, you are taking a particular type of risk, namely you're holding an asset. If it gets shorted aggressively, you're just going to eat that and then have to deal with the counting loss elsewhere. Now, this is a 10 trillion asset under management company. So out of all the companies that can allow this big swinging of NAV, it would be BlackRock. Okay. Smaller spot ETFs. So if you're watching this and your whole MO is to game this, guys, then this information is more valid for the non-BlackRock ETF, spot ETFs than it is for the other ones because this index arbitrage thing is true. It's not even I mean, there's a part of what I've done in the past that does touch this, but it's not my core skill set. So go find someone whose core skill set is index arbitrage, specifically ETF index arbitrage, and they can explain to you precisely how to do this. But it is the case that because BlackRock has 10 trillion assets, out of the folks that were approved, they are the least likely to be gamed this way because they have a few more options on what they can do. But if you're a smaller ETF, then this would be the gamesmanship that you'd be watching for. Okay, that's all I have prepared for tonight on BlackRock. And also because I knew the BlackRock Bitcoin ETF stuff would come up, there is that. Let me do some shout outs. And then if there's questions, please put them in. There's a little bit of a tiny delay before I get them. So definitely put your questions in if there are some. Dylan Miller, I already gave you a shout out. Super cool. Super Steven. Hey, what's up? Is it true BlackRock bought? Like, I don't know the answer to this, Super Steven, but they would probably, if they have a spot Bitcoin ETF, they do have to be a buyer to support the assets that are coming in. So be aware of that. And probably they would pre-buy that, knowing that, and then they probably already had some folks that were happy to do the initial, whatever it is, to support that. That's my guess. I don't know 100%. There's probably a representative at BlackRock that if you emailed them would answer that for you right away. Oh, Grandpa Barney, how you doing, buddy? Happy New Year. Thank you so much for stopping by. And that's it. I know it's really late. Thank you guys for coming in and watching this, and have an amazing trading week. Happy Martin Luther King Jr. holiday.